housing price increase and is creating this gap in this middle class. What if increasing interest rates actually makes the problem worse? And I'm not going to go so far as to say that on the show, but I think it's interesting to note that increasing interest rates, there is a legitimate explanation that could say will not solve the inflation issue. So then where does it come from? Because I think that's the writing on the wall for a lot of people in our overvalued market. But if it doesn't happen, then what? We keep going? Good morning, investors. Bradley here from Watson Estates, and you're listening to the largest, fastest growing podcast for Toronto real estate on iTunes, Spotify, and Google Podcasts. As a broker and investor here in the GTA, I like to keep track with what's going on in the market. Been doing this for years. Podcasts for the last year and a half. We've become the biggest because people are curious on what's going on, getting a little bit of an explanation behind all the cuckoo-ness that is the Toronto real estate market. We need someone to save our souls. I guess Jesus does that, but save us from inflation. And interest rates has been kind of the promise to do that. And interest rates are bound to go up. In fact, there's a lot of prediction for up to 5 rate hikes in 2022. That's the highest betting odds right now. But today I want to take the devil's perspective on this. As a devil's advocate, how increasing interest rates might not help inflation. And some would say maybe even continue to increase inflation. And if that's the case, we might be screwed. So we're going to talk today about what's going on in our market, kind of look at, luxuries, rentals. We're going to go all the way through, get a good feel for what's happening here in Ontario. We're going to talk about some policies that are kind of rolling out. What are how the Ontario Real Estate Association is pushing and some of their ideas for dealing with the housing crisis and some of my own better ideas. But of course, we're going to talk about this whole interest rate conversation. So we got a really good lineup for you today. Coming up in the next few days is Remembrance Day. Make sure you guys pick up those poppies and celebrate. It's a good chance to remember, especially when you are like me. For those of you who don't know, I have a wicked short-term memory. It paid off really well during school. But my long-term memory, not so good. Not so good. I really only recall some of those insignificant memories of my childhood, or more significant, rather, memories. Like I remember one time I was playing with, we're building sandcastle actually, me and my great grandmother, and it was fun. My mom decided to take away the urn, that kind of blew it. But anyways, obviously we like to have some fun on the show, keep it lighthearted. Working on my comedy routine. We're currently putting together a masterclass if you guys are looking to get into investing. And I've got a lot of feedback to incorporate some of the fun, some of the jokes, the lightheartedness into that. So we're really excited about that. If you want to find out more, there will be more coming. I don't have a link to send you just yet, but stay tuned. Early into 2022, there'll be something for that. But how you can support us right now, today, hit that like, subscribe to our show. You can share this with your friends, tag us at Watson Estates. And hit me out with a DM if you guys want early access to the masterclass, but we'll stay tuned for more info on that. So let's start off today with a market update. Let's look at what happened. Now we got the stats coming out of TREB for the month of October rather. And so we're going to break that down. You guys have probably heard today's November 8th. So in the last week and a bit, you've probably heard that the Toronto housing market is on a tear. And we forecasted it. We talked about how that would be the case. And we expected that. It's on a tear in the sense of price, but it's not necessarily on a tear in the sense of sales. And so you got to have really a high level perspective on how all of this works. The story was that sales were declining. There's an opportunity in the market. Maybe things are cooling. This is finally your chance. The housing market has reached its peak. We said no, that the numbers do not spell that. Well, I think people have a really good picture on how the last few months, those sales have been steady, in some cases rapidly. We'll talk about that in a minute. Rapidly declining. Sales price is going up just as fast. So here we go. Let's look at some of the stats. Prospective home buyers in the Greater Toronto Area found dramatically fewer homes on the market last month than they did a year ago, pushing sales down and prices up. When we look at sales are down nearly 7% from a record of 10,500 in October 2020. So keep in mind, yes, we are down 7%, but we are competing against a record 2020. So in the big picture, still outpacing 10-year highs. But when you put it up against 2020, we see it as a decline. So some people still see that and lean into that as a sense of hope. Well, they say despite the fall, the result was still the second highest level for the month of October, even as the number of new listings fell by about a third compared with a year ago. Big drops, yet it's still high. Maybe COVID was just an exception to the rule, and I think that is the case. They say every housing type was impacted. Every housing type was impacted by the heated conditions, which included fewer people putting their homes up for sale than last year when a pandemic buying frenzy was on the horizon. So we have to pin the sales up against new listing. Those are really the ultimate balance on how much inventory is there in our market. Yeah, we see sales drop, which is fine. If we see listings rise, that could tell us we could be entering more of a balanced market. Well, that's not the case. New listings is dropping even faster, way faster. So we've got a drop in sales of 7%. Why don't you had you bet on what you think the number of new listings dropping is? 34%. 34% from the same month last year. You thought last year was tight? It was tight. It's getting worse. It is worse. And I think in some ways, out of all of this, if I were to obviously there's so many factors and every one of them is the biggest issue on this podcast. That's a poke at all the people that provide information. It always seems like the biggest thing on that show. Maybe it's not the biggest thing, but for this episode, it's the biggest thing is people don't want to deal with selling their home first. People are stuck as it's a cycle, right? People say, I don't have a place to go. It's getting so tight. There's nowhere for me to go. Now, there are companies that are trying to address this all around us. But I think there's a solution in here. I'll share that with you in a moment that should happen industry-wide. And if it doesn't, I might, still on the fence, but I might single-handedly try and address that issue. But that, I believe, is a massive issue. People don't have a place to go, so they sit on it. They stay within. They deal with renovations. The government, in some cases, is supporting you to stay and renovate and update your unit to live there longer. And people have just decided that that's the way to go until something's got to give. What's that something? Interest rates. Interesting how that all works, but we'll talk about that one later. Price. Obviously, price is going up. We said that. Average home price in homes soared by almost 20%. When you've got a drop in sales at 7 and got a drop in new listings of 34, a 20% increase in price kind of makes sense, but I actually expect that could go far higher. There's a big question right now in our market. Do I wait to sell until the spring? And I'm getting a feel that in our market, people are anticipating a hot winter again this year. I know I kind of told you guys we'll keep an eye on that, and I've got a lot of my clients that are looking to list on standby for that. I think there's a big wave, and there's no numbers to back this up. This is a feel. This comes from the real estate industry and conversations I'm having. You might find listings skyrocket, matching sales skyrocketing month over month going into the new year, not necessarily waiting until March to happen until the spring. But here we go. So let's look at the breakdown. Detached homes average more than 1.5 million. Semi-detached rang in at nearly 1.2 million. Townhomes, 957,103. And condos reached just over $700,000. Very expensive. But is that a mystery? No. Where is it going to go from here? That's the $1 million question. But I guess $1.5 million question. But let's look at the growth by segment. So if we were just to say I have a portfolio, I got a detached, I got a semi, I got a town, I got a condo. What did they all do? Well, the detached homes rose in the last year, almost 30%, 28%. That's crazy. We saw a 24% increase. So third best was semi-detached. The second best was actually townhomes at 28%, and a measly increase, pathetic, in the condo space of 13%. Still pretty good. Imagine if a market just went up 10%. People would still say this is overheated. 13%. Yet here it is, condos, the worst player, double the average of 50-year average of how housing prices this year alone. And yet it's just, terrible investment, that condo. But a lot of people look at it from a perspective of, this is really a limited resource mindset, whereas if the detached home is rising 30%, my condo is rising 13%. Well, good luck with the move up. But people aren't doing that anymore. Well, yeah, they are. We'll talk about that as well. There's a lot of stuff we got to talk about today. There is an urgent need for more housing supply. That's the ultimate solution, is if we can deal with supply, then maybe we'll figure it out. Here's a fun idea for you. Don't tell anybody where you got it from. Use it at your own discretion. You didn't hear this from me, but I'm so fascinated by the wholesale community and how they're kind of mingling within the real estate market, where there's kind of failure to find deals on the open market. There's this wave of wholesale buying off-market properties in order to get a deal, and it's kind of creeping itself back in. Just like it reminds me when we saw the stress test kick in, a lot of people kind of moved over to this kind of hidden world where there was less regulation. Well, I think that movement is also happening in wholesale, but maybe you, as a real estate sales or real estate agent, real estate investor, someone who's looking to purchase on MLS, maybe you just came up in a multiple offer situation and you got a firm sale, and you got a decent price. So let's say you got 5 offers and you won. Well, here's an idea. And obviously, if you're going to do that, be prepared to close on that property. I guess that kind of comes with the territory of wholesales. Be familiar with it. But what's to stop somebody? I have not seen this, which is why it's innovative at best. The idea of adding an assignment clause to your purchase. If you can get a selling agent with willingness to assign it, you can say whatever you want. I'm going to assign this contract, or I have the ability to assign this. You now have a platform where you could hypothetically turn around to one of the losing bids, if you know who they were, or just the market in general. You won out this bid. You've got a property which in your mind is undervalued compared to the price. Now people have evidence of what the actual price is. Make a $15,000, $20,000 bump up in the wholesale price, or worst case scenario, you close on a property you like. But could we start to see more assignment? Hopefully I didn't just start a new trend in our market, because that could be really, really bad. But at the end of the day, the ones that I care about most are our listeners. This is why you're here. Don't tell your friends. Said the largest host of a Toronto podcast. Anyways, so that's the overall market. And there was a lot of conversation that luxury is usually the first to take a hit when it comes to the market tanking. And in fact, we kind of saw that a little bit during COVID. Well, would it not go on to say that if the luxury market is doing well, that's an indicator that there's a lot of opportunity in our market? Well, yeah. So when we look at the Toronto luxury real estate market, here's what we see. They say, this is from a Toronto Stories, a stories.com article. Perhaps surprisingly, one of the Toronto real estate sectors that has experienced particularly strong bounce back is the luxury realm, right? We see this drop all the way down. Now we see this bump all the way back up. Quote, we have definitely seen a significant increase in luxury sales during 2021. So those sales are down. In the luxury space, sales are up. In fact, year to date, 2021, now the first 9 months was exceptionally strong in 2021, but still, almost 2 times more than the previous record in 2017. So 2017 was the next best year pre-collapse of the market because of the foreign buyer tax and the stress test and all that fun jazz that happened and slowed the market down, hit the luxury market hard after that. But up until that point, that was the top until now. Not only did we beat that, we doubled it as far as the number of sales in what some would say is actually a slightly lower sales number than what we saw last year, but a true and full recovery in a sense of the luxury market. We're talking luxury 4, 5, 6 million plus homes. But why? What could be causing that? Well, they say in this article, the biggest shift in trends we've seen is more upsizing rather than downsizing. In a lot of ways, what was once a downsize has become an upsize as far as price goes. You might be buying a smaller home. You might be buying a luxury condo. Our brokerage right now is working on a $7 million condo in Toronto that has a pool in the unit, penthouse beauty. But that's a downsize. That was actually a downsize. This is a client that's moving from Oakville. That's a downsize as far as space goes, but it's actually an upsize as far as price. So how do you measure that? Well, if we look at luxury real estate, the price, I believe, is really the trigger on if it's up or down. And so people are looking for space, and it comes at a cost, even though it might be smaller and it typically would have been further out. Some of these further out markets have outperformed. We see that in where the detached is relative to the condo. That gives you a little picture of that as well. But moving on, they say people have been forced to reassess the way they spend their time at home and have placed more priority on office and outdoor space. Now with the need to work, learn, and live all within the same 4 walls, all of this is leading to people looking for more space, which is coming at, in COVID times, post-COVID times, or current COVID times, depending on how you look at things, it is coming at a cost, a premium. But it seems the COVID lockdown is still fresh in our minds. Even amnesia can't cover up that one. Unless you're my dad. He truly suffers from short-term memory loss. I just hope it doesn't run the family because my dad has it too. What about the rental market? So we got the rich paying a little bit too much. Poor rich people. We got the average Joes getting squeezed because of this inflation, which we'll talk about in a moment. But what about those that they've been forced, they've been pigeonholed into the rental market? Grab on your rental now before the affordability crisis brings us to another tier, which is homelessness, as evidenced by what's been going on in our city. But this rental market, this next tier, good indication of what's going on. We've been seeing a lot of flat, a lot of stable in that market in the last few months. We've noticed a bit of ups and downs, which is usual for the month, but no significant growth in price, which was interesting because we saw a pretty rapid increasing in price and it seemed to have plateaued. Well, guess what? Toronto rents are soaring, they say, particularly in one part of the city. We won't get into any details of where, but this is a BlogTO article that breaks it down for us. And their stats come from live.rent, which we've partnered with in the past as well. Here's what they said. For the first time this year, the average rental price for the Greater Toronto Area has risen solidly above $1,700, solidly, according to LiveRent. That's a jump from $1,696 in June of this year. So we now are starting to see an increase in that rent rate. The report notes that the upward trend in rent prices could be an anomaly. Anytime you see this increase, this is actually what happened last time we saw this increase earlier in the year. There was people wrote it off as an anomaly for like 3-4 months. But when you're starting to see the demand factors coming back that we are, I'm one of the quicker ones to say not an anomaly, not an anomaly. There is a lot of support behind that rent increase, leading to the fact that it could continue to go up more likely than not. But they say we'll have to wait and see whether this is simply an unexpected exception to the stable price of the past few months or the start of a longer trend. I believe it's a longer trend. That's my thoughts. That's my 2 cents. That's why you're here. Spend it how you will. Don't know how much you could buy with that, but at least not these days. So is there a viable solution? And in this ever changing pursuit of dealing with the supply crunch, the supply crisis, our friends over at the Ontario Real Estate Association, we had Tim Hudak on the show the other day, but we got a message from their president, David Oikel. And by the way, why are there different people? Tim Hudak is the CEO. David Oikel, who is an elected official, is the OREA president. He sent out an email to all the Ontario Real Estate Association members, which is i.e. realtors as part of that association, identifying the government has delivered this thing called the Fall Economic Statement, Build Ontario. And part of it, they said that were a few wins for Ontarians. And here are the wins. We'll start actually with number 2 and 3, and then we'll get into the last one. So number 2, the government will make changes to incentivize building more housing on brownfield sites to help increase housing supply across Ontario. What is brownfield? Is that like some gross area? Yeah. It's actually a perfect description. It's currently vacant. It's an area that was previously developed and it's been abandoned, underutilized. You guys could probably think of some spaces in and around your area that's like that. And it could have some potential contamination because of past industrial activities. So the idea is we want to be able to utilize this, which I think is a great thing. And the government is now pushing to do more of that. Number 3 idea, the senior home safety tax credit is being extended for another year. What is that? Well, it's worth up to 25% of the money you spend up to $10,000. So for quick math, that's $2,500 in credits you could get if you're kind of updating your home for safety. You know, you're putting in one of those really like super lit like chairs that ride up sideways up the side of your house. But I think you have to need it. But those types of things, those type of renovations are being supported by the government. Keeping people in their house longer. Very helpful. Very, very helpful. But the idea, the number 1 idea that they had, the big one, was Ontario proposes a housing affordability task force amid high prices in sales. Here's what a report says. Looking at this is from the CTV News. They say Ontario is planning to establish a housing affordability task force as both prices and the number of home sales have grown in the past year, though it's a pledge that the opposition parties dismiss as meaningless. When they say home sales have gone up over the past year, they're looking at the entire year, even though we see a little slow now compared to year over year. It's all like whatever. Naturally speaking, the point is a hot competitive housing market. So to give you perspective on how fast prices have climbed, let's look at that over the last year. In 2020 to 2021, Ontario, the province, got $3.7 billion in revenue from land transfer taxes. We all love paying those, don't we? Another reason keeping people in their house. In this fiscal year, 2021 to 22, it's projected to skyrocket to more than $5 billion. 3.7 to 5 billion in 1 year. I say that's even 759 million higher than it was projected in the first quarter finances, which was released only 3 months ago. So there's a lot of money that comes in the form of land transfer. I mean, at this point, we need the money in order to pay back a lot of the spending that has happened, but geez. And as mentioned, a lot of it comes from the first 9 months. Here's just to give you a perspective. When we look at the CREA stats, they haven't come out for October, but looking in September on a year-to-date basis, home sales totaled a record 216,000 units over the first 9 months of the year, which was actually an increase of 28% from the same period last year. So for those first months, because let's face it, who wanted to do a lot of sales and transactions right in the middle of COVID? Not many. Well, because of that reason, we saw an net increase in sales so far this year. But obviously the party has ended. Nationally, home sales activity has declined 17.5% from year ago levels in September. So in the more recent past, we see sales actually going down year over year. But hopefully it ends up in a bit of a flat scenario, up, down, whatever. Let's try and keep things comfortable. I like predictability. I like prices going up 5 to 7%. That's healthy. Let's do the same for sales. We'll keep things moving forward. We'll stick to the average. Average is sexy, right? What's the plan? What is the plan then? Quote, we know there is still more to do, which is why we are creating a housing affordability Space Force, to identify other opportunities to get shovels in the ground faster, remove duplication and barriers, and make housing more affordable for hardworking Ontarians. That's Zoe Knowles, a statement of Director of Communications, and that's from the government. Thank you, government. Quote, it will explore measures to support market housing supply and affordability and provide the government strategies and advice to continue to address Ontario's housing crisis. The only thing better than a plan is a plan to plan, and that's probably what this is. But they do say so far there's been an increase in new home starts, which is nice. Year to date, we have a 16% increase from the previous year. Rental housing seen a 14% increase. So far, so good. Hopefully that continues. But we also see from the Ontario Real Estate Association these kind of ideas. We see a lot of this lobby, if you want, and that was actually a part of our conversation that we had with Tim the other day. But what are some of the suggestions that they would have happen? A lot of what they suggest ends up happening, which is why they send out these success emails. But here's what they're saying now. They would like to see the government take several steps to address housing affordability crisis. They want to see the end of exclusionary single family zoning. In other words, I want to be able to take my single family and switch it. I want to turn it to fourplex. Sweet. Every single family home in the city can do it. And we've seen this in other countries. No, we won't get into that today, but we've talked about that before on our show. They want to double the land transfer tax rebate. Let's get some of that money back, man. Sheesh. $5 billion. Man, let's get some of that back. Well, okay. So in other words, let's boost demand further and make surplus government land available for development. Yes. Thank you. Amen. Right. More supply. Sure. Housing critics, though, they're not buying it. They ain't buying it. Man, creating another task force, delaying real action. We're not actually doing anything. We're just talking about doing stuff. But here's an unpopular opinion. Maybe the Conservatives are finally tired of being lobbied and criticized about this whole housing thing. We're doing our best, man. Look, we got a 15% increase in the number of houses. You guys still complain. Now they're just taking out their anger. This is like beating up this memory foam pillow, which worked great for me. Really did, until it learned my moves. But here's an idea. Idea alert. A lot of good ideas today. Here's an idea for you. What if, hopefully there's no bank executives listening to this. What if we required major banks to offer, maybe we do beyond major banks, but let's start there, to offer Canadians a bridge loan pre-sale. So you don't need a sale document and you don't in order to close on the purchase. The big problem right now is, what if I don't want to go buy something? Okay, here's the dilemma. I wasn't planning on talking about this, but we got to really lay out all our cards here. The dilemma is I want to move. I do. I really want to move. I'm willing to even pay all that government costs and land transfer tax to do it. But I'm not confident I'm going to find something. But people are looking back at 2017. And they recognize there is legal implications of buying and then not being able to sell your home. Let's say the market changes. Let's say interest rates do in fact have an impact, freaks everybody out psychologically, and nobody buys in my house. Now I'm stuck and I don't have a mortgage because banks do not offer bridge loans unless I have a firm sale. So now I have to sell my home first, but the market is getting tighter and tighter. So what am I going to do? I'm going to use a senior's tax credit and I'm going to stay the hell here. Good luck to the next generation finding any openness or supply. So what if the banks were able to offer some kind of loan? Not only be able to offer, but were required to offer a loan. Obviously, there'd be more details behind that. There'd have to be fine print in order to protect the banks to do it. But if there's an honest attempt, maybe we have an appraisal form or appraisal process built into that, whatever it looks like. Would that not solve our problem? We got people moving again. That's the goal. Now, I would be totally working on this constantly. I already know how we would resolve this, but honestly, because we're working on this masterclass, I don't have the time. This is the problem, right? You got money. There's lots of money in an economy like this, but nobody has the time. And today my time is being spent building this master class. That's how important I think it is, because we need to teach investors how to buy a property. The goal would be that people would buy an investment property, or at least be fully able to buy within 90 days or 3 months at the end of our program. So there's a bit of a plug for there. But when this is all said and done and that gets launched, if nothing has happened, this is the first place I'm seeing it. I see companies trying to, take advantage or capitalize on it, but I haven't seen any real change at the government or political level. If it doesn't happen, we're going to do something about it. Okay. I'm getting fired up over this. And where I would kind of circle that in is, if you have deep pockets and you believe what I'm saying as well, please reach out. What we would need in order to overcome this would be deep pockets. And obviously there would be a pretty good financial incentive for you to deal with that. That's something that I have on the back burner. It's on the second stove in my $6 million, $8 million. Oh, whatever. But we'll see. I'll keep you guys posted. We like to have this fun side projects. Once you've got a nice business, you've got clients, you've got things rolling, you like to have fun. You like to have little podcasts like this, have these ideas. And I love entrepreneurship. Investing is entrepreneurship, man. That's what it is. But here we go. According to Ontario, though, that's not the issue. The issue is that strong demand is coming from low interest rates. So interest rates is the problem. And we've said that because I believe that's the case too. Higher overall disposable incomes. People have more money to spend on an investment property, and limited resale listings is shifting home preferences. And that's the big problem, right? The supply. So that's the combination. That's the pain point that's happening in our market. But Bradley, interest rates are about to rise. Interest rates are going to go up. The tool to lower inflation is coming, right? The solution is here. Well, I thought so until this week. And I saw an article that increased my eyebrows. And then I realized the impact it had on the creases in my forehead, and I put my eyebrows back down. But I looked a little bit closer. And I'm not so convinced anymore that increasing interest rates will prevent inflation. Inflation being what drives your housing prices up, or is resulting housing price increase, and is creating this gap in this middle class. What if increasing interest rates actually makes the problem worse? And I'm not going to go so far as to say that on the show, but I think it's interesting to note that increasing interest rates, there is a legitimate explanation that could say will not solve the inflation issue. So then where does it come from? Because I think that's the writing on the wall for a lot of people in our overvalued market. But if it doesn't happen, then what? We keep going? buying more, right? So here's where it comes. I'll give you guys what I read, an article, and it was actually posted by Quentin D'Souza, posted somewhere on social media, and that's where I found it. I'm like, this is freaking interesting, which is why I'm sharing it with you today. This is fedguy.com. And this is a US article, but it is very similar. Like, the concept is exactly the same as I would expect it to be in Canada. And it's just really food for thought. Here's what it says. A structural change in the plumbing of the banking system is dampening the impact of monetary policy and may even make rate hikes inflationary. That's the claim that they make. I'm not going to claim to be an economist, and this took me several reads to understand exactly what's going on. But once you kind of wrap your head around it, very interesting. Rate hikes now directly increase the asset returns of banks. So that's the first point. When we increase the interest rates, banks increase interest rates. The way that they can still be competitive in getting that money to compete with other banks is to increase the rates for deposit holders, right? That's the kind of the flow. So as my profits as a bank move up, the rates, I need to offer a more competitive and higher rate. And so a consumer says, hey, I'm not going to buy real estate then, because I can just, there's more of an opportunity cost to leaving my money in a bank account, which is paying me a higher return. So I'm going to stop investing in real estate, which is risky, and I'm going to put it into the bank. Well, the problem that's happening here is that they're leaving funding costs unchanged. That's the balance, effectively encouraging credit creation. So let me read the 2 points here and you'll get the whole picture. So what's going on? Because banks have shifted their funding structure away from rate sensitive money markets. Instead, they're going to rate insensitive retail deposit funding. So what's happened in the last little bit was COVID. A lot of money got poured. It just got flooded our market. People had just all this extra money. Where did they do? They put it into the banks. Banks are saying, thank you for the money, right? what ended up happening is the banks no longer need to borrow money from the money markets because I have deposits from this over liquidity in our marketplace. And that's really the balance. It's a combination of raising the regulatory cost of the money market funding, so now it's more expensive, and also the superabundance of retail deposits from the pandemic fiscal spending. But then on the depositor side, so for someone who would have put money into the bank, the public is unlikely to see the increase in deposit rates that would arise from the competition for funding. And the reason is because of there's just being so much. There's already so much. They're paying themselves. Like they're just paying shareholders. There's so much money in the banks. What do I got to give you more in order to compete for more money? I don't need it. This means the opportunity cost of holding cash will remain low well into the hiking cycle. So therefore, I'm not taking my money out of real estate to put it back in the bank. I'm going to just leave it in real estate. And the profits for the bank get so much higher. And there is an incentive. Obviously, they're making money. Canadians are making money. But those who are making money are those who are in a position to benefit from an inflationary period. The way you would tamper things down, you'd slow down housing prices, was have a place for people to put their money other than housing, i.e. increasing interest rates, making it less affordable to do that. But if interest rates go up, the banks are making more money and there's less of an incentive for us to move that money. Inflation pursues. Interesting. Banks are less dependent now because of COVID on money markets. Their assets benefit from the higher asset return. Meanwhile, bank liquidity is super high thanks to COVID, so they don't need to offer higher rates, so people won't move their money. I know. The short thing here, to really summarize it, is the banks don't need to borrow money at higher interest rates. So if you increase interest rates, I don't care. I have money from depositors. And that is going to increase the margins because I'm not impacted by the increase in interest rate. Interest rates will not impact the bank, will keep money in real estate, and therefore not do what it's supposed to do, which is curb inflation. So then do we get on this train of ever increasing interest rates more and more in order to actually have an impact? How does that all flow through? I do believe at some point, increasing interest rates will bring prices. It'll stabilize our market. But articles like this make me wonder, by how much? And how long will it take to happen? Anyways, interesting food for thought for you today. Hope you're hungry. Like and subscribe to our show. Please support the channel. You can share this. If you learned something today, you can share it on Instagram. Tag us at Watson Estates and DM me. In the meantime, if you're interested in joining this will be for early access because we don't have a place to send you yet, but it's coming. It is coming. If you're interested in getting in our coaching program, be one-on-one coaching, and you'd be looking to purchase a property in the next 90 days. A really exciting platform for people who want to do what we're doing, which is become an active investor. But yeah, I've got a bad memory, but I've never forgot to support you listeners. And the way that I like to do that is through jokes. It's my way of saying thank you, right? And luckily, you know how much money it takes how much memory it takes to make a joke? Blew it. 1 gigabyte. I still think it's funny though. I just said it wrong. But anyways, hope you guys learned some stuff today, and I will see you next time. Take care and keep it real.